the first real concept that we want to talk about is something called the goal of the firm. What do managers think about, right? Everybody, let me put it this way. Shareholders in particular agree that they're better off if management makes decisions that maximizes the value of their shares. So instead of using this word goal, maybe we use the word benchmark, right? Why do people buy stock? They obviously want to increase their wealth. They want to increase their wealth by receiving dividends, and they also want to increase their wealth by seeing the value of their assets increase. So what happens then if management cannot provide the desired dividends and or returns on stock? Well, the investors are going to say, well, look, if you can't give me the returns that I want, why would I give you money? In fact, they may withdraw their funds, sell the asset that they have because management can't get the job done. What do you think happens when many of the shareholders receive or determine they're not happy and they vote with their feet and they start selling the stock? Obviously, if most investors are unhappy, what they're going to do is sell, and if everybody is selling, ultimately the stock price will go down. So the question, is profit important or is shareholder wealth important? And this is the primary question that most managers struggle with, right? Managers are typically assessed on how much profit they create for the company. And we're not really saying that profit is a bad thing. What we're saying is if you're thinking about making a decision for a company, right, the benchmark that you need is something that the owners of the company want. The owners of the company want to maximize stock price, not necessarily profits. I'm not saying that profits are bad, it's just that stock price is more important to the owners, right? So what's the problem with profit? It's backward looking, it doesn't look forward. It's dependent on accounting principles. So you can change profit by changing your accounting methodology. Profit itself does not consider cash flow timing, and it ignores the concept of risk. It is a accounting measurement. So it doesn't incorporate the riskiness of generating that amount of profit. So these are the questions that management deals with in their process of doing their business. So how does this affect society, right? Often a corporation's decisions that increase the value of the firm will essentially benefit society. So as long as nobody's better off or worse off by a corporation's decisions, the value of the firm's equity is good for society. It only becomes a problem when increasing the value of the firm comes at the expense of others, at the expense of owners, suppliers, customers, etc. That's when this concept of value or value creation could be detrimental to society as a whole. So this kind of leads us into the concept of ethics, right? What role should ethics play within a corporation? And we want to concentrate on a single concept within ethical decision making. We want to talk about the idea of something called agency. Managers may act in their own interest rather than in the best interest of shareholders. So this is a contradiction of their contract with the owners. Owners hire them to do a job. And what owners want from that job is they want to see the share value increase. So when managers act in certain ways, through purchasing, through acting, through the efficiency with which they run the company, all of those actions can be detrimental to the value of the firm. So anything that they do is in violation of this contract. So one of the solutions we have is obviously we have to find a way to tie management's compensation to firm performance. The question we have, the question that research hasn't been able to answer for us is, what is the best performance measurement? Is it earnings per share? Is it the PE ratio? What number is it return on equity? What number should we ultimately use to determine this? So the process of how we can control managers, right, manage managers, has to do with three basic concepts. Corporate control. The threat of a takeover may result in better management. What happens to the current management team when the firm is taken over? Well, a first question might be, why is the firm being taken over? Is one of the reasons, there could be others obviously, is that the management team is not creating value that investors feel they should take. So somebody sees this opportunity and they purchase the firm. Of course, if managers can't get the job done, we don't keep them. This concept is something called a hostile takeover. Obviously, management does not want to be taken over because they're going to lose their jobs. So we need to have something in place, good management, that will keep the stock price high enough that we do not have to worry about the company being taken over. We have an audit function, right? We audit the company's books because we want to see the whole picture. We want to make sure we know as much about the good things that are happening and also about the bad things that are happening. There are insurance arrangements, bonding that we can purchase to ensure that management acts the right way. And finally, we need to think about compensation, right? There are tools that we might be able to align management with stockholder interests. We could create a system of bonuses that are tied to some goal, some metric, and that would ensure through that measurement, we could then provide stock options, right? Companies that owners would receive, or managers could receive, so that they ultimately could cash these in, if you will, when they do the right thing, which is to increase the stock price. So CEO performance, right, is very important. If they're not performing properly, right, we can sell their shares. This selling pressure we mentioned drives down the stock price. Lower stock prices could entice a corporate raider to buy enough stock so they could replace the current management. Assuming that this fixes the company, the stock price could then come back up to a higher value for the remaining owners. A brief discussion of the stock market as we finish up. The stock market provides liquidity to shareholders. The ability to sell an asset quickly, right, is a very important concept. You want to be able to sell the assets that you own. The more liquid it is, the less risk you have of getting stuck, in quotes, with a poorly performing asset. So the stock market provides liquidity. It also provides the price creation mechanism. This is the process of supply and demand of investors that helps us to set or determine what the prices of an asset are. One brief technical piece is something referred to as the bid-ask price, or the bid-ask spread, excuse me. So the ask price from an investor's perspective is the retail price. That's what you pay when you buy an asset. The bid price is the wholesale price. When investors sell assets, they sell it at the wholesale price. So this bid-ask spread reflects the commission that is earned by investors, or excuse me, by brokers. The wider the gap, the riskier the investment, or the lower the liquidity, but also the higher the profit that goes to the brokers who are holding these assets in inventory. So what this represents is a cost to investors of a transaction. So I'm going to kind of switch gears here. I'm going to go out to Yahoo Finance. I've already pulled a couple of these up. And what you can see from here, let me minimize this a little bit to get it into our frame, excuse me. But this is Coors, and what you can maybe see down here, I'm trying to get this into the frame. When you go to Yahoo Finance and you input Coors, TAP is the ticker symbol, they provide us some information. Here you can see that the bid price is $96 and the ask price is $98.50. So when you buy a share of this, you could pay as much as $2.50. Again, this is averaged. $2.50 is the cost of buying a share of this through the marketplace. If you could convert $2.50 into a percentage, you can see that's a rather high percentage. What about, waiting for it to work here, Harley Davidson, right? We have the same kinds of information. If you look at Harley Davidson, the difference here is $2.06, $62.94 minus $65. So we can see it's about a $2 spread. But let's look at P&G. Everybody knows about P&G. We know what that company is. And if you scroll down a little, excuse me, I went too far. Excuse me. Sorry, I'm out of here. Well, what I can tell you is that the difference in price, the bid-ask spread for, I'm trying to get us to a point where I can find this for you. Excuse me. There it is. Let me go here, PG. Again, you just type in the symbol, it comes up. And again, hopefully if I can get this to work right, we go down here. We saw the difference is $91.38 is the ask price and $91.30 is the bid. So in this case, the cost to investors is only 8 cents a share. Why the difference? P&G, relatively speaking here, is a more liquid company. It's probably a more or a less risky company in general than those other two companies. Again, I just wanted to point out that the prices that we pay are important, and the riskiness of the asset are also incorporated within this concept of creating prices and moving forward. The last thing I want to talk about is a technical thing. It's the difference between what's referred to as a primary market and the secondary market. You're aware of what the secondary market. This is where you and I purchase shares of stock from other investors. So this is investor to investor transactions. The primary market is where investors go to buy stocks from new companies or new issues of companies. So this is not investor to investor. This is essentially investor to corporation. So in a primary market, you're buying shares that are being issued by a corporation. The corporation gets the money. In the secondary market, you are purchasing shares from other investors, and those investors are getting the money. So again, it's a technical aspect, but later when we talk about how corporations get money, we need to know the process. The process is through something called primary market transactions. That's the end of chapter 1.